or probably the next couple of sessions are primarily targeted towards uh, the manipulations that are possible in the financial statements, both in the P&L as well as balance sheet as well as the cash flow statements. So there's a strong focus on the quality of the financial reports. Quality is nothing but what is the potential of they being manipulated, or what are the various warning signals for us saying where the financial statement could have got manipulated. What are the various pointers which we can use to say that there might be a possibility that this statement is tampered? So some of the initial assessments on these aspects are being covered as a part of this session. The first thing is, see, on the income statement, on the P&L statement, what we are saying is the end result that comes up is nothing but net income, which is the profit after tax. Some companies may look at overstating it. Some companies may look at understating it. There are different motivations for doing both of them. Sometimes they could be done within the scope of accounting standards. Sometimes they could be done slightly outside the scope of the accounting standards. There's a thin line of difference between the two. So wherever a company is doing outside the scope of the accounting standards, we are calling it as a fraud or manipulation. But coming to why someone wants to manipulate the financial statements. So when we are talking about overstating versus understating, there are different motivations for both of them. When you are talking about overstating, the main reason is share price. Analysts, they always say, to maintain the company in the good books of the financial analysts, the more profits I show year over year, quarter over quarter, it may so happen that majority of the analysts will recommend a buy recommendation on the share price of this company. So see, though there are various aspects of financial statement to look at, some of the primary aspects which every analyst will look at is the profit. A base analyst who does not have too much of in-depth understanding of financial statements, who has a basic understanding, he may look at the profit as a number, the net income as a number. Oh, this company's net income is increasing year over year. So probably we'll give a more and more buy rating. So the analyst expectations, to meet the analyst expectations, and also from a debt covenant standpoint, we have seen that as a part of the bond indenture, as a part of the covenants, the lender might put a restriction that your current ratio should be something equal to this, or probably your return on asset should be equal to 15%. So if my net income has gone down, I would not meet my lender's requirement. So either he may ask me to pay back the principal because I have not met the requirement, or he may charge a higher interest rate also. All are possible. So just to showcase those kind of things, so it could be either out of greed or out of pressure. Right? Probably if we see here, oh, there is a pressure from the analysts. Right? Probably the analysts, okay, let's say you are the analyst. You have given a buy recommendation on this company shares for almost 100 of your clients. Right? Suddenly, when the profit of the company goes down, the analyst's reputation will be at stake. Right? So there could be some kind of pressure from the analyst also to maintain a higher profits. Second, from the lenders, there could be a pressure. Or if it's not a pressure, it could be a blackmail. If you don't maintain this much of a ratio, probably either we may ask you to pay back the entire loan. These are mentioned at the prospectus layer itself. So to make sure that no such issues come up in the middle, the companies may tend to show higher profits. And sometimes management salary is tied up with the profit, right? With the P&L statement, probably some percentage of the final profit is what you will get as an increase in your salary. So they want to show a higher number so that their compensation, their salary will increase accordingly. So there are different motivations. There is a greed angle in some of the cases, and there is a pressure angle in some of the cases. But at the end, these are some of the motivations which will make any person to over report the earnings in the P&L statement, net income in the P&L statement. Whereas some companies try to under report the earnings to get some kind of trade relief and subsidy. Right? My profits are completely down. Look at my P&L statement. I'm almost running into losses. So give me some subsidy. I can apply for a trade relief. I can apply for a subsidy from the government. And even I can negotiate some terms with my creditors. You give me a 30-day more credit period. I'll pay it back to you after 30 more days. Or even with the labor unions, I can negotiate a salary. Right? This year we have not made enough profit, so probably you bear with us for one more year. Next year we'll increase your salary. To negotiate such kind of contracts, they can't even tax reliefs and all these kind of stuff. Or sometimes it's even more a game now. This year, this quarter, companies want to show a lesser profit or probably a loss. And next quarter, they want to show a higher profit. With this, what is that they are trying to showcase? We have bounced back. From a loss scenario, we have created a huge profit scenario. Probably we have bounced back drastically. Rather than saying we are more or less constant, they want to showcase that kind of a feeling. Okay, even in one quarter, the company was slightly bad. Now they are bouncing back drastically, which means the company has a very big growth prospect now. They want to intentionally showcase that movement. Right? The impact is much more. From a loss scenario, you are again going back, but in reality, it's a manipulation. So these are some of the reasons why companies would like to understate their earnings also in a period. So overstating and understating, as long as they are not within the lines of the accounting standards, it's a fraud. Right? Probably a company may switch from straight line depreciation method to a written down value method. As long as they can justify a declining balance method or some other depreciation method, they can very well move on to. As long as they can justify what is the motive behind it. See, these all probably from a FIFO based inventory, they go into average cost based inventory. There's nothing wrong in that. But as long as they justify what is prompting them to go for that kind of a movement. Right? But these are all within the scope of the accounting standards itself. So they are not considered as fraud. But, okay, this year's revenue showcase as the next year's revenue. Or this year's expense showcase as the next year's expense.